Obviously, payroll tax is something the employer pays. This seems a bit counterintuitive to me because you want to encourage people to be employed. Why do we have this?
Your land tax and the payroll tax, both of those taxes sort of being seen as robbery.
When governments are in deficit, they need to find ways to raise revenue, I guess.
That's right. So payroll tax is very heavy, right? And it's definitely not a popular tax. It's a tax that, again, unfortunately, we got to pay. No one can know everything at all the time as such. We're not supposed to, right? But the tip behind it is that before you make a final decision on any big financial matter.
Hello, everyone. Welcome to another installment of the Investing for Doctors podcast. I am B, and today we have here with me Mr. Munzurul from KHI Partners.
Thank you.
Hi, Munzurul.
Thank you, B.
Again, today we're going to be talking about the taxes. And today is going to be talking about the more state-based taxes and the things that we haven't covered on the previous podcast. Without further ado, Munzurul, I'm going to start firing some questions, and I hope you enjoy this podcast. In a previous episode, we have talked about what every individual gets taxed at sort of almost a federal level. And, fortunately or unfortunately, we live in a state-based Commonwealth system where depending on the state you're in, you're also subjected to additional taxes.
That's right.
So, maybe give us a historical point of view how all of this came about and why are we paying taxes at the state level and at the federal level?
Yeah, good point. It's a very good question, actually. And then if we look back, Australia is a country as well as a continent, right? And as a country as well as a continent means that each state has its own level of legislation, has its own level of budget, its own level of sort of the power as such, right? So that was sort of the old history where sort of the individual state tax sort of came in. And the way this whole legislation sort of works is that we've got the overarching, the federal tax, so to speak, but there are certain areas the government sort of says is that you guys tax at your own way. Right, at your own way, whether it is an independence, whether it is a competition in between the states being done. So a typical example of the state tax, which is not part of the federal tax, would be your stamp duty as an example, right? It's a state tax. Your land tax as an example is a state tax, right? And if you look through payroll tax as an example, payroll tax is a state tax. So there is a whole bunch of other little things, but there are this state tax, and then at a federal level, you've got the income tax.
Yeah, absolutely. And I think that's something that we often forget about that as doctors, because we actually travel from state to state often in our careers for training opportunities, for fellowships. And when you move from one state to another, the rules you thought apply in your home state may not apply in a different state.
Absolutely.
But thankfully, a lot of those taxes are on assets. Would you say that's sort of correct?
Yeah, that's right. I mean, if I look back to the stamp duty as an example, if I look through the land tax as an example, that's sort of an asset-based tax, right? I mean, payroll tax is more of an employer earning bit of
level.
tax as such. Yeah.
Yeah. Okay. So, we mentioned land tax. Let's start off with that. Why is there a land tax, and how did that come about in a way?
Land tax very often, and the reason we're both laughing is because land tax very often gets very passionate.
Yeah.
It gets very personalized, right? In the sense that very often the landlord sort of comes in and say, what is the damn rationale for the land tax, right? Is it not an additional tax? Simply because that my land values are over a certain amount, you as a government, you're charging me an extra tax. And you know what? I hear this question and I say, I don't know whether I can answer this in any other way. It is an additional tax. It's an additional tax simply because you are the landowner of over a certain level of threshold. Now, to make it complex is that each state is different. And
different thresholds.
Yes, there are thresholds that are different, and each structure has got a different rate. Yeah. So New South Wales, as an example, is that as an individual, you get about 1,075,000 or so as a threshold. Anything over than that, you pay land tax. Victoria, Queensland, as an example, you've got a 600,000 as a threshold. Anything over 600,000, you pay land tax, right? Victoria, as an example, believe it or not, only 50,000.
Yeah,
and anything Anything over 50,000 you pay land tax. But it depends on which entity that you do. If you're buying it on an individual, those are the threshold. If you're buying it on a trust, as an example, New South Wales, no threshold. Queensland has got a $350,000 threshold. Victoria, on the other side, has got $25,000 threshold.
Yeah.
Right?
Yeah.
So each state is different. If you look into ACT as an example, believe it or not, there is no land tax because you don't own anything on ACT.
It's all leases.
ACT is about lease. It's a long lease, right?
Yeah.
It could be a 99-year-old lease. You don't own anything. And if you don't own anything, you don't pay any land tax. So it is varied. And it's an additional tax. Now, the commissioner comes in and tries to justify saying, all right, we're charging you the land tax purely because it's a wealthy and we're trying to balance it out in between the wealth and sort of the non-wealthy.
It's a tax on wealth at the end of the day,
It is
isn't
a tax on wealth.
And also, I guess in a way, the government needs to maintain infrastructure for those pieces of land. Is that the
It's a revenue
some of the
generator
rationale?
for the government, right?
Yeah.
It is a revenue generator for the government, and the government sort of say which area that we target as a revenue generator. This is where the landlord's sort of coming through. Now, I must say this, that the land tax is a tax deductible expense, right? There is only a handful of taxes which are tax deductible expense. This is where the government is sort of saying it is that, well, we're charging you quite a bit of land tax. All right, we'll give you a little bit back because you can claim that as a tax deduction. Where it gets a bit harder is that from the investor's point, we think it this way, right? That an investor has got 2 or 3 or 4 properties, they're getting a certain amount of rent, and simply because their asset base is over a level of threshold, they're paying the land tax. But you can't, on a residential property, you can't sort of pass that to anyone, right? Like you don't get an extra $20 rent purely because you're paying the land tax.
Yeah.
Commercial property bit different though. It's not uncommon on the commercial properties to negotiate that the tenant pays the land tax, but the residential property, unfortunately, land tax goes back to the landlords.
Yeah, that's right. And obviously, when we talk about land tax, there's also exemptions as well. So, for instance, you mentioned your own home that you live in has land tax exemptions.
Yeah, your own home has got land tax exemption, you're right. And the second most common one is the primary production. So if you genuinely have a primary production, not so much I've got 4 or 5 cows and cubs and sort of I'm sort of pretending that I'm a primary producer.
Yeah, hobby farms, I think,
none
don't
of the
count.
hobby farm, like a real sort of, it can be reviewed, it can be audited. But if it's a primary production, it's an exempt from a land tax point of view. And principal place of residence is an exempt. And very often that short-term rentable premises may also have an exemption.
I've just got that here, and there's about 10 items.
Yes.
Includes council land, interestingly.
Yes,
Councils
right.
don't have to pay their own land
Yes.
tax. Beautiful. And also things like childcare center, retirement village, and caravan parks.
Yes.
Again.
Yes.
So
That's
there's
short-term lending.
Yeah, so there's a whole lot of different land uses that are exempt from land tax. So the thing is that every state is different, and the rate depending on the entity you're holding is also different. For example, I believe in Victoria, the land tax rates are different if it's under a trust or under individual as well.
That's right. So if we look through, let's say New South Wales as an example, right? New South Wales land tax is 1.6%. Now, what the definition of that 1.6% is the Governor General's valuation of the unimproved value of the land. So what that means is that when we have 1,075,000 as a threshold, it's not the real market value of 1,075,000. It's a very conservative value. On that example, your real market land value, but very conservative land value, right? On that example, your real land value could be, say, a couple of mil, but because it's Governor General's valuation of the unimproved value of the land, means that there is no infrastructure around it. That's how they do the valuation, right? So that 2 million may come back to 1.075. Land tax rate is 1.6% on that example in New South Wales. If you look into the Victoria, as you said, is that Victoria goes on a rate depending on what's the level of the income, right? And if it is on a trust, they charge a surcharge.
Yeah,
So
the surcharge.
not only
yeah.
that 25,000 they charge, surcharge, and that surcharge sort of increases as well.
Yeah, I'm not going to ask you to give me the exact numbers because when I look these things up, it's actually quite hard to find these numbers on a Google search.
It changes every year because of the CPI, right? Number one. And number two is that it's sort of different in between both. And I suppose the couple of comments which are taken here in terms of take a step back and learning side of it, right? One is that you can still plan the land tax. How do you plan the land tax is that you can diversify in between different estate. That gives you a different level of threshold. Yes. You may be able to diversify in between different structure. That gives you a different level of threshold as well. And number three is being very aware of it upfront, exactly what the land tax implications are. And do your investment on the basis of it.
Commercial and factor that in.
That's right. Commercial property, as an example, is that land tax perhaps is being passed back to the tenants. Very common, right? Residential property, as an example, is that a common tip is that if you buy it on a joint name, husband and wife, you get one threshold. But if you buy only on husband's name as well as only on wife's name, you get two level of threshold. So still there is a whole bunch of planning that one can do, but then eventually it runs out.
Yeah, I guess when you join it together with say husband and wife, and if they're 50-50, 50% of that goes to the husband, 50% of that goes to the wife. Yeah. And if there's any imbalance there, then it just tips over.
It's being treated as a partnership, right? Yeah. So, say example, very common is that people buy properties saying that, well, we want to buy that on a joint name, joint tenancy in common, whether it's a 50-50, whether it's 90-10 and all the rest of it, right? Sometimes people do that for two reasons, right? My experience. One reason is that very often people say, well, we do that because we need both of our income to get the loan. Now, that's the myth that I want to take that away. I want to take that away in the sense that your loan can be on a joint name, your property can still be on a single name. Husband and wife, they both can be on a joint name on the loan, but the property can be on single name, right? So that's one. And the second reason why people do that at times is because of emotional reason, right? Husband, wife, everything balanced out. We do it as a 50-50. Challenge is when you do 50-50, you get one threshold of 1,075,000 because it's being treated as a separate entity. It's being treated as a partnership under the land tax. So it doesn't even get subdivided into 50-50. You go straight. As soon as you go into 1,075,000 or more, you pay land tax. But all you had to do is to buy property 1 on his name, property 2 on her name, and property 3 on his name, property 4 on her name. No common to it. And then you get 2 lots of threshold. So these sort of little tips are the ones that must speak to an accountant in advance before you buy it. Because once you buy, you buy.
Well, once you buy, you want to transfer. There's unless you do a divorce and split it out that way. There's no other ways to get past the land tax.
No, if you pass it in any other way, you're actually selling it from him to her and her to you. Other. And there is a capital gain tax and arguably, and there's a stamp duty to it as well.
Yeah, so now I'm going to ask you a bit of a tricky question, right? In this situation, you had this joint venture between husband and wife, and there's, the 1.7 million threshold.
1,075,000.
Sorry, 1,075,000 threshold. Then if the husband went to buy by themselves, and then the wife by themselves, right? Do they get another 1 million plus and another 1 million here?
Good question. Very good question. It's actually very complex math. And what it does in a complex math is that they always treat the partnership as the first assessor. That means, do we have a land tax obligation in the partnership as a first assessor? Right? If there is a first assessor, you pay land tax in there. Absolutely nothing we can do. Then what they do is that when the husband sort of buys it, they actually get a pro rata of the threshold within themselves. So they do get a pro rata on stage 2. So it sort of becomes a little bit fairer.
It's tiered.
A little bit fairer on tier 2, but you've already paid a whole bunch of tax in tier 1. So that's why the golden rule, what we say is that unless there is a really strong reason, perhaps not to buy on a joint name, loans can be on a joint name, but not so much of the title.
Yeah, exactly. And I mean, look, liability and ownership and, also things in the family court, these are 3 things in parallel. And we we shouldn't mix them all up to think as one.
Because see, on the family court side of it, family law, it doesn't really consider whose
Structure.
name the property
Yeah,
is.
it doesn't matter.
No, family law says that we'll set aside all of those, whether it's his name, her name, everything is being done jointly, right?
Yeah.
So family law-wise doesn't matter. Liability-wise, it does matter, right? Because if let's say the wife is sort of earning quite a bit of higher level of income, she's on a higher level of the risk, right? Then do we want to buy this property on her name where the risk is high, where the husband could be the income is a bit lower and the risk is lower? Do we buy it on his name, right?
Yeah.
And there's no one answer to it. You may still want to buy it on her name purely because she gets a whole lot of a tax benefit against it. It could be negative gearing, she gets a tax benefit, right? So the comment would be in here is that while there is no one answer to it, all of those must be considered before you make a decision.
Yeah, exactly. Wow, awesome. And that's already a very complicated topic in its own right. So next, with land tax, we touched on this stamp duty.
Yeah.
Stamp duty is something that, you pay essentially to get a stamp. And I'm not even sure whether that physically happens anymore. Does it?
I think it's all electronic nowadays.
Yeah.
Is to say that we register, but there is no physical stamp anymore.
Yeah, I want my damn stamp.
No, you pay for it though.
Yeah. So stamp duty, or some places called transfer duties.
Yes.
It's essentially, I guess, transactional cost. The way because like there's stamp duties on purchasing a vehicle, there's stamp duties on setting up a family trust in New South Wales. There's stamp duties for that. Whereas in say WA, there is no stamp duty on
Same as
trust formation.
Queensland.
Yeah. So why do we have this?
Yeah, good question. And again, to see why, first, I suppose the answer which I want to give, why do I have a varied level of, why do I have a stamp duty in New South Wales of $750, nothing in Queensland, nothing in Western Australia, right? Because it's an individual state basis. They're the one who sort of makes the decision whether we impose a stamp duty or not. And then it's being done to create the competition and all the rest of it, right?
Between the states, you mean? Or
in between the states, right?
Okay.
And the states sort of within their sort of a competition. Now, why do we have a stamp duty? Stamp duty is again a fundraising mechanism from the government, right? And you would see government plays with that stamp duty very often, right? Very often that the government plays. So Victoria is a classic example, right? That Victoria is sort of imposing all those land taxes, stamp duties and everything else over the last 2 or 3 years, particularly since COVID, because Victoria has taken
there's been a levy
approach.
on that.
That's right. Victoria has taken an approach saying that we as a Victorian government, the state government, is that we've got a whole bunch of deficiency and we need this fund to be raised to meet the deficiency. And that's the pathway that we want to take. Do I agree with this personally? No. Do I see a lot of dismerit to it? Of course I do, because if you look through some of the prices in Victoria at the moment, is that the Melbourne prices
really
are much
affected
lower.
the property market there.
It has, right? Like if you look through median price now, which is August 2024, in August 2024 is that the median price in Queensland and Brisbane is higher than Melbourne, right? And if you look through the history on
been the
the
other way.
price, is that it's always Sydney, Melbourne, Brisbane. There's literally only about 2 to 3 times in history that Brisbane become more expensive than Melbourne. Now is one of those times that Brisbane is more expensive than Melbourne. And a good reason behind it is because of all the state tax that got strongly being imposed in Melbourne, which we don't have anywhere else, right? Now, very often they do that, right? But it sort of changes around, right? So my sort of view would be is that this will change in Victoria as well, because they can increase the rate as much as they wish to, but if the people are not doing transaction enough, then you're still not getting it, right?
Yeah.
So you still need that volume of the transaction. Right. So you need that volume of the transaction. So you're right. Like each state is a bit different. Why do they impose? It's a fundraising in terms of, I suppose, cost bearing in terms of.
I guess historically, back in the days of the old British Empire, that was a way. That was probably one of the few ways they could actually tax someone at that point, where a guy came in and said, "I'm going to sell my land to Mr. So and so they exchange the deed, and then the government will stamp on it and then say, hey, okay, you got to pay this amount as you do it. Whereas nowadays, that kind of things do not exist anymore. And so everything is done electronically.
Yeah, 100%. You're right. I mean, many of our tax system, because we're Commonwealth-based tax system, right? Our tax system, they all came in fundamentally from the British tax, right? I mean, that's why we've taken that initial tax. If you look at 200 years ago, is that our tax was exactly the same as British tax. Now, yes, it has changed, evolved, and both ways. Now, if you look into England is different. We are very different. But that fundamental element is still there. And you're right, stamp duty is one of those fundamental elements.
And I think there is some, quite a bit of move and discussion to get rid of stamp duty and to convert that into a land tax kind of thing. So, when people buy properties, there is no stamp duty.
Yes.
And then they pay a higher rate of land tax in compensation.
Quite strongly being discussed. You're right. Quite strongly being discussed for a few years now, right?
Yeah, it's been going on for a while.
And the reason why that's been discussed for quite a few years is that land tax has sort of quite strongly become a prohibition in terms of the mom and dad sort of buying their first home, mom and dad sort of trying to buy their first investment property. So government is very actively sort of saying that, well, how do we still create that volume? It can increase, again, coming back to that point, right? It can increase the rate as much as you wish to, but if the volume is not there, we're still not getting enough level of funding. How do we do it? How do we do it? How do we do it in terms of the volume side of it? And if I think it through, because the prices are increases, right? Whether the price increase every 7 to 10 years, whether it doubles, but every time when that sort of price increases, our land tax value is also increasing as well as a percentage, because you've got a bigger base. So it's becoming harder and harder and harder for people to buy it, right? And then we look into the income side of it, right? If we look through the inflation, if we look through now, August 24, our latest inflation says about 3.5%, right? But generally speaking,
but that doesn't include the land.
No, it doesn't. But generally speaking, we sort of say 2 to 3% is the inflation. Now, if we say 2 to 3% is the inflation, what is our wage growth? Our wage growth it's right now is 4.1%, right? So you've got about 4% is the wage growth. But then on the other side is that set aside inflation. If we look into the price increase, the average property we say doubles every 7 to 10 years, means that you get 7 to 10% compounding return. So there is a disparity, seems to be, in terms of the price growth of the property, as well as the salaries and wages. And because there is a slight disparity behind it, is that it gets harder and harder and harder and harder to buy
enter the market.
So the government is sort of saying, how do I create more initiative, right?
And these grants where the first homeowner stamp duty exemptions for first homeowners obviously come into play, and that helps.
100%. As a first homeowner, right? Absolutely. There's some threshold that you need to buy below than that, and all the rest of it, right?
And that changes every year.
So that's there, right? But then when you go to the first investment property, let's say if someone is buying a $1 million property, right? You need a bare minimum 5%, give or take, as a rule of thumb, as incidental cost, as stamp duties, all the rest of it. So you need $50,000 to save just to buy this property. Then you need a deposit. Now the doctors get 90% up to 95% as a loan, but you still need to save 5 to 10%, right?
Well, that's at least $100,000 in that situation.
So you minimum saving that 100,000, even if you go the most favorable position, 95%, right? You need 5% as deposit, 5% incidental, so you need 10% of that million, you need 100,000. Now, by the time you save that 100,000, the prices also changes. So it always seems to be that you are sort of a bit of cat and mouse, right? It's a catch up. So government has been discussing quite strongly that can we change that stamp duty into a more sort of additional level of land tax levy, so to speak, so you pay that over a period of time. Now, they're looking at a lot deeper into the commercial property now. That's easier to implement and to bring that back into the residential. There's an argument to both sides. One side of the argument is that it opens up the market. The other side of the argument is that if you don't do it the right way, it would be the ultimate winner, believe it or not, would be the existing landlords. Because all that will do is that will somehow flow back within the economy, and the prices will increase. And by doing it this way, the newcomer who is sort of paying it, they're paying higher level of the price. because the entry is easier, but the winner ultimately are the people who already are very wealthy. So that the whole purpose, what it was being done, it's sort of not sort of achieved. So if it's not being done in the right way. So that's the debate which is going through at the moment, that there are merits to the mechanism, but how do we
implement it without destroying the system?
In the right way? Yeah.
That's a complicated topic, and I've never thought about it in that way. I mean, it's a revenue raising exercise. If the way I saw it was almost like they lose this upfront sort of cash flow, but then they are essentially almost amortizing it over the eventual future. There's obviously pros and cons in that. There's more liquidity in people buying and selling properties. If someone wants to downsize, they can downsize a lot more easily without paying, clipped by the government. I should put it that way. And but I didn't think about it the other side.
There is a threshold to it as well. It was interesting because there's a whole lot of maths being done, right? And generally speaking, I'm generalizing, right? There is a threshold saying that longer you hold the property, more the government wins.
Oh, yes,
and
of course.
Shorter you sort of hold it, more you do transaction, more you hold. And there is almost a sort of a threshold years, and that year is about 6 or 7 years, is that if you hold much longer than that period of time, because
it's better to pay a stamp duty.
It's better to pay stamp duty because that bit of the pro forma of that yearly stamp duty, you pay it forever, right?
Yeah. So, and you don't get that inflation adjusted creep up. So it's almost easier to pay it up front and, feel that pain up front.
So it's still in discussion, and it's still sort of in negotiation. So we'll see. Yeah,
we'll see what happens. It's been on the talking point for a long time now.
Easily about 2 to 3 years. Easily.
Yeah. So even before that, they were probably talking about it, and then now it's come into the public's awareness. But to be honest, I don't see it coming into play anytime soon. That will affect most sort of early stage investors, I would say. The other thing we touched on, payroll tax.
Yes.
Right. So obviously payroll tax is something the employer pays. And from an employer perspective, that's just additional tax once you go over a certain threshold of how many people employ. This seems a bit counterintuitive to me because you want to encourage people to be employed. Yes. And again, I'm going to ask the same question. Why do we have this?
Your land tax and the payroll tax, both of those taxes sort of being seen as robbery, right? Is tax on wealth and tax and counterintuitive. Right, absolutely, right? So payroll tax, as an example, each state is different, right? So New South Wales, as an example, you've got a threshold of about $1.2 million or so, right? And anything above that level of the wages, you pay an additional 5.45% tax, an additional 5.45, right? So that really adds up rather strongly. It's a tax deductible expense, mind you. So employer gets 1/4 of it back, so to speak, 25% if the marginal rate is 25, but 5.45% on top of it. And it's not only just the wages, it's the adjusted wages. So any level of super gets paid as part of the payroll tax, right? Any level of allowances, bonuses being paid as part of the payroll tax. Any level of director's fees, incentive being paid, effectively everything is part of the payroll tax, right? So it adds up very, very quickly. And the common question which I hear all the time, which I agree with you, is the question that it makes no sense simply because that I'm giving more employment to more households, and purely because I'm giving more employment to the households, you are charging us more payroll tax. And to make it even worse, they get grouped together. Grouped in the sense is that you may have 4 or 5 different entities, and you've got control into all of those entities grouped it together. You may have shareholding at a controlling level grouped it together as such, right? You may have an associates and relationship loan in between those entities, funding in between those entities, everything gets grouped together. And once it gets grouped together is that you only get one threshold as opposed to different level of threshold, right? So payroll tax is very heavy, right? And it's definitely not a popular tax. It's a tax that, again, unfortunately, we got to pay. And to make it even more complex is that when an employer has multiple estate and multiple level of employment in multiple state, they all have their own level of the payroll tax. And very often is that they're very reluctant on giving threshold within each other. There are some threshold within each other, but more rare than common, purely because the states sort of work independently within themselves, right? So that bit of the threshold is sort of very nominal level of threshold. So there is significant level of complexity. It is counterintuitive, but it's a tax.
Well, it is what it is. And I guess the topical subject is on dental practices and general practices being slugged with payroll tax. That's one thing, and I think the other thing is that there are some large corporations where are employing doctors as VMOs, and they are getting slapped with payroll consideration for payroll tax. As deemed employees and all of that sort of stuff. So I guess there's a lot of things like that going on in the background in terms of deemed employees for superannuation, deemed employees for payroll tax. And I guess the commentary here is that when governments are in deficit, they need to find ways to raise revenue, I guess.
That's right. And what we probably should do is that at some point of time, we should go a lot deeper into the payroll tax, right? Similarly, the doctors has got all those PSI, PSB, and so on, those very specific doctors matter. But you're right. I mean, this whole payroll tax over the last couple of years within the medical industry, it just brought in so much shivers.
Anxiety.
So much anxiety.
Yeah, absolutely. And I definitely agree with you. We need to revisit that topic at a later date and have a very sort of deep dive into it. I'm going to finish off with another topic, and it's about inheritance tax.
Yes.
Yeah, we all know that in Australia we do not officially have inheritance tax, but there is talk about it, and there is also talk about taxation on excessive wealth in a way in the form of superannuation. We all know that there's no tax on inheritance, but when you transfer your superannuation to another person, it's not entirely true that there is no taxable event happening there, is there?
No, inheritance tax by itself is that there's just so many different elements to it, right? So we'll come back to the super, but say individually as an example, right? That when you receive an asset as an inheritance, is that you don't pay tax in day one when you receive it, which is true. Yeah. But what it does do is that eventually when you sell it, you pay the tax. Yes. So if those asset was purchased by, say, mom and dad, where we received as an inheritance before 1985, then what it does is that we get them as a cost base, as a market value, my apology. We get that as a market value. Let's say mom and dad bought it in 1980 and it's being passed it to, say, us now, is that whatever the market value now, that becomes my cost base. And eventually when I sell it, the gain that we're making from today to the time that I'm selling it, I got to pay capital gain tax at that point of time. Not that bad. Where it becomes silly is that if mom and dad were to buy it after 1985, let's say they bought it in 1986 and they bought this property for $50,000, and now this property is sitting at $2 million, right? So yes, at that $2 million, I'm not paying any tax, but when I sell it in about, say, a couple of years' time at $2.2 million, I got to pay tax on 2.2 minus that 50,000. Which is mom and dad bought. So the tax becomes very, very, very heavy. That's on the individual side of it, right? When it goes to the superannuation fund, there's many things. First, fundamental on the superannuation fund, same as the individual, that do we have a will? Do we have a right level of will? If it's a right level of will, it goes into the right level, right? So super fund side of it, you've got this concept called binding debt nomination. And binding debt nomination effectively says who gets that super fund as such, right? If you don't have a binding debt nomination, it becomes an absolute disaster in terms of tax side of it, right? But again, on the super fund side of it, it comes back that who are the beneficiaries? Are the beneficiaries adult? Are the beneficiaries as non-adult, right? And that by itself has a tax ramification. So super fund, when it goes from the super fund to its subsequent members, there are some tax consequences. It's not a tax-free. There are definitely some tax consequences. It all depends on what level of binding debt nomination that we have and who is the ultimate beneficiaries, but there are some tax.
Yeah, exactly. So whilst we say we don't have inheritance tax, there are things that will get taxed when time comes, either immediately or in the future. And that case about, you know, the property, if afterwards you get it at the cost price, that's a huge tax liability.
That's a huge tax on that example, that 50 grand and 2.2 mil, random example, right?
But it happens. It's still profit.
And you know, when you get a $2 million asset, it sounds great, but when you're sort of selling it at 2.2 and you know that effectively the entire 2.2 is subject to tax, you may get a 50% discount, but your 1.1 now becomes $550,000 tax. So all of a sudden you say, hang on, that 2.2 is great, but on the other side, I've got a $550,000 tax that I'm sort of paying. It's heavy.
Yeah, exactly. So yeah, lots of things to consider, I guess. But obviously, all of the things we talked about today are subject to legislative changes.
Of course.
And
of course.
Whatever happens today in 2024 is maybe different in 2025.
Absolutely.
Yeah. All right. So look, that's a quite a comprehensive sort of discussion about the other sort of state-based taxes we talked about, and some of the pitfalls and some of the interesting idiosyncrasies, and without scaring everyone, the good thing is that a lot of these don't kick in until you have a good enough amount of wealth, or they only kick in or they're calculated for you in a way in terms of land tax when you have a lot of investment properties. And again, for the listener, you need to have a chat with your accountant or have a look at the rules and regulations that is pertinent to your state, and before you make any sort of financial decisions.
I think that's the tip, right? Is that, say, no one can know everything at all the time as such. We're not supposed to, right? And no one can be a specialist in every single field. Even the specialists are not a specialist on every single field. But the tip behind it is that before you make a final decision on any big financial matter, bounce it off. Bounce it off with your financial planner, bounce it off with your accountant, bounce it off with your mortgage broker, bounce it off with the team of the members that you have.
Someone. Yeah, bounce it off with someone.
So if you're buying an investment property as an example, bounce it off with your mortgage broker. Can I get a loan? Bounce it off with your accountant. Which name do I buy? Maybe even which estate that we buy from a land tax. Bounce it off with your lawyer, right? That am I buying it in the right way? Whether there's any other contingent liabilities that we need to. So it's all about the bounce it off before you make the decision.
The conveyancer, and that's not often the case. Yeah. Awesome. Thank you so much for that sort of deep dive into the state-based taxes. And I hope we've learned something today. Thank you.
Thank you.